equity markets continue to generate negative returns as investors still expect the US Central Bank to keep its policy rates higher for longer. There's an increasing probability that the Fed could even consider raising rates by 25 pips before the end of the year. Locally, we are seeing our markets being driven primarily by US and European markets. One of the biggest economic concerns for South Africa seems to be the budget constraints. The slight relief we had recently from a steadier supply of electricity does seem to improve the mood somewhat. The long-awaited provincial GDP series was recently published. Though it does not come as a surprise, it is still quite interesting to see the economy of Gauteng being larger than that of the Western Cape and KZN combined. Even though some business cycle indicators such as manufacturing, motor trade and restaurants recorded positive year-on-year gains, the downside is that some meaningful and important sectors came under pressure. Mining, electricity generation, construction, wholesale trade and retail trade were weaker. Briefly looking at the numbers, we see the JSE closed on 72,382 points at the end of September. The repo was left unchanged at 8.25%, though not all members of the MPC agreed to leave rates unchanged. From a financial planning perspective, we like to share some valuable content. So this month, we look at some updates regarding the two-pot retirement system. The latest update states pension and provident funds, preservation funds and retirement annuities are required to comply with the new two-pot regulation. It also includes public sector funds as well as defined benefit and defined contribution funds. There are two important dates. T-date refers to 1 March 2021, and then there's the implementation date, when the two-pot retirement system will be implemented, being 1 March 2024. Now, any retirement savings which have already accumulated prior to 1 March 2024 are classified as a member's vested component. This may consist of a member's vested benefits resulting from provident fund contributions prior to 1 March 2021, which refers to the T-date, plus growth and non-vested benefits. The member will retain all his or her current rights of access to those benefits after 1 March 2024. In actual fact, you may want to look at it as three pots, as there's the vested part, the retirement part, and then also the savings part. Keep an eye out on our communication, as we will share a blog post on this shortly. Recently, the Conference Board surveyed CEOs in the United States, and 84% of these CEOs expect a US recession in the next 12 months. Interestingly is that the yield curve analysis where the 10-year minus 2-year bond is used indicates only a 61% chance of a recession. Now, another interesting number in our interesting number section is that of 50% of all retail investors in global markets, and this according to the Retail Investor Report, preferring to invest their funds in a dividend type strategy. Now let's look at some individual asset class returns. It was actually a terrible month as local bonds, local equities, local property and even the MSCI ACWI all delivered negative returns. Please read through some of our manager commentary and remember to also register for our upcoming webinar on the 31st of October, where we will feature 3 of our preferred managers. Now this month, we look at our stable income model portfolio. From a planning perspective, this model is often used in the very short-term space where a client may have the need to access the funds within a year or two. Do remember that this model portfolio consists of income managers with both a capital growth focus and a focus on using instruments for income generation. That said, this model can be measured using both a total return percentage as well as looking at the income distributed over time. Though we measure our models based on the 4 investment pillars of outcomes-based investing, we also illustrate the return numbers. And what an exceptional 1-year number we currently see of 9.8% for this model. This also results in an excellent RAND outcome for the client, while we manage to focus on the risk and also focus on consistency. We again see that we've managed to improve on the consistency numbers of the ZISA category. Now, this model is available across most major lists, so get in touch if you would like access to this model. Our last couple of slides showcase the excellent returns of the rest of our model portfolios and our two income models compared to the CISA categories over the relevant time horizons. In all instances, the models performed well in excess of the CISA categories when considering their recommended time period that we use for each of these specific models. Now, in case you missed any of our hedge fund webinars, please feel free to visit our YouTube channel and subscribe on the channel as we post all of the recordings there. Our website has undergone some aesthetically pleasing changes, and the range of our model portfolios with the 4-pillar feedback can also be viewed there. And then lastly, remember to please share this quick video summary with your network and your clients. And all of the content we've discussed now is also available in a downloadable PDF.